Welcome to the Museum of American Finance's evening program, Calling the Shots, Investing in Sports. And I'm David Cowan, President and CEO of the museum. And for those just learning about us, we preserve, we exhibit, and we teach about the nation's finances and financial history. And tonight we're going to hear about one of the hottest markets in finance, whether it be private investor groups, big organizations, athletes themselves. Everybody wants to invest in not just teams and stadiums, but all types of content, technology, collectibles, and media. We are witnessing the explosive growth of sports as an investable asset class. Now, I'd like to acknowledge the generous support of our co-sponsors this evening, Bright Path Sports Partners and their co-founders, Phil Ciano and Jake Sanow. Bright Path is a private equity and advisory firm deploying Native American and traditional investment capital into professional sports, entertainment, and related opportunities. And our second co-sponsor is Broadridge Financial Solutions and their president, Chris Perry, who is a museum trustee. Broadridge is a global fintech leader supporting the industry with communications, technology, data, and intelligence solutions. A special thank you to Paul Taylor, the CEO of Fitch Group, and museum trustee Eileen Fahey, the chief risk officer of Fitch Group, because they have arranged for this beautiful space for us this evening. Now, if you want to learn more about the museum, we have other trustees in attendance, including our founder and chairman of the board, John Herzog. Our chairman of the board is Peter Cohn. We have several other fellow trustees here, Bob Pisani, Scott Riddle, Dave Schuler, and Dan Baru. Now, I want to have a huge thank you for Mindy, wherever you are. This evening does not happen without Mindy Ross. You've been working for months, and we're so appreciative. There's one other person I did want to point out. He has 9 sports Emmys, got his start on Monday Night Football, covered many Olympics, and it's my brother who happens to be here, Rob Cowan, so you can talk with him later about that. Now, it's my pleasure to turn it over to one of the sponsors, Chris Perry. He's president of Broadridge Financial Solutions. He's been with Broadridge since 2020, and under his leadership, they've experienced record-setting sales and a record-setting stock price. Chris will share how Broadridge has made a commitment to sports and, in particular, Olympic athletes. Chris.
Thank you, David. Good evening, everyone. It's a pleasure to be here. It's been a pleasure and a privilege to serve on the board of trustees for about the last 5 years. I actually joined Broadridge in 2014. So 10 years ago. I was made president in 2020, so thank you around that. And yes, it's been an exciting run in our market cap, going from a few $1 billion to about 25 billion over the last 10 years. Now, all of us, in my view, have a responsibility to ensure that the heritage of the American finance industry and finance globally is treasured. And one of those obligations comes right now in making sure you do that text right up there to pledge and invest. I'm sure you made some investments today. Make that text. This is the history that we want to preserve, and David, you and your team do such a fabulous job of doing that. So I guess you're all wondering, okay, what is the president of a fintech, global fintech, doing up here talking about investing in sports? And the reason that I think investing in sports is so important is 2 things. One, we support companies around the world that do technology and investing, and they look for companies that have serious cash flows, great client bases, great customers. And if you look around, sports does that really well. There's this little thing happening a few miles away later tonight that, several 100 million people would be paying attention to. It happens to be a sporting event. And I just came back from LA. I was in LA Friday, Saturday, Sunday, and they're going nuts. And there's plenty of money being invested there and a lot of ROI that's happening. Now, New York has to do its version of that. So sports is the real deal. The second reason is that there's a war on talent out there. And David alluded to something that we do uniquely in our space. We sponsor 10 Olympic athletes, women's rowers. We went out and said, where can we be differentiated in our recruitment? And we stumbled upon women's rowing in the collegiate level. And there's these amazing women athletes that get up about 4:45 in the morning and they're on the water by 5. And they are out there every day training like crazy. The problem is they don't have any money. See, America does not send athletes to the Olympics. Americans send athletes to the Olympics. That's different than most other countries. So it was really exciting for us to sponsor them, wherein they work about 20 hours a week. And that's usually from about 12 to about 2 to 4, something like that each day. So they can train in the morning, strategize middle of the day, work for a little while, and then go back to their real pursuit, which is an Olympic medal. We were very happy that we had 10 Olympians in the finals this year from our company. That was very exciting. Our best finish was 4th, but the 4th place team in the entire world is a pretty big accomplishment. So there's a war on talent. I think athletes are proven and disciplined. It's a great place to go get great associates, whether they are beginning their career or whether they're finishing their career and they're looking for opportunity. I think that's the other element of it. So tonight we have a great program for you to connect with investing in sports. And our sponsors, Bright Path Sports, we have basically the 2 co-founders that are here tonight. And I would like to introduce Jake Zanow, who's the CFO and co-founder, who will open the program. Thanks, Jake.
Thanks, Chris. I am honored and grateful to be given the opportunity to introduce CNBC Senior Markets Correspondent, Bob Pisani. Bob has been a familiar face on the floor of the New York Stock Exchange for over 2 decades, offering insights and market trends, investor sentiment, and economic developments. His deep understanding of market dynamics, combined with straightforward reporting style, has made him a trusted source for viewers seeking clarity in an often complex world of finance. Throughout his career, Bob has covered numerous financial events, including market booms, crashes, regulatory changes, which have given him a unique perspective on the evolution of the global financial landscape. His work has earned him accolades in the industry and continues to influence both professional investors and everyday viewers alike. Bob's experience in explaining complex financial issues and trends to a broad audience makes him an ideal fit for guiding discussions on the evolving intersection of sports and investing. Tonight, Bob will steer a conversation on the emerging investment trends within the sports industry, including such topics as private equity's increasing involvement in sport, team ownership, sports betting, media rights, and the impact of technology on both the fan experience and fan engagement. Please welcome the legendary Bob Pisani.
Thank you, Dave. Thank you. Very much appreciate that. When Mindy and David called and asked me to participate in this, I said yes immediately for a very simple reason. I'm a financial reporter. I'm going into my 35th year at CNBC. I'm proud to say I'm sort of thank you. I'm sort of the last of the Mohicans. I'm the last person still on the air from the first year of CNBC. I went on the air in 1989. I was on as a guest in that year, but I wasn't hired until the summer of 1990. But I'm the last person still on the air from the first year that it was on. And I've seen a lot of changes, and this is one of them. I cover largely the financial markets. I cover the stock market in particular, but essentially I'm a financial reporter, and sports has become a major financial story. We always knew about the passionate fan base around sports, but that's different than what we've been seeing in the last few years. It's not really an exaggeration to say sports is the last truly global event that people can unite around. And the investing world is paying a lot of money to be a part of this. I work for NBC, but the company ultimately that owns NBC is Comcast. Comcast has gone all in on sports. I don't know if you saw it, but just a few months ago, they announced they were spending $2.5 billion a year for a 5-year contract for the NBA, for just parts of the NBA. $2.5 billion for pieces of the NBA. That is a lot of money. That's an all-in, I think, commitment from Comcast. CNBC, who I work for on a daily basis, has itself started a sports reporting division separate from the normal division of people like me that comment on the stock market. So we have number one, stratospheric prices for teams, particularly NFL teams. It's going to be mind-boggling as the numbers that we've been seeing. Private equity is getting involved, as you heard from Jake. We have a lot of interest from the public and the viewers and how they can get involved in it. So we've had a sort of perfect storm of interest here from a financial reporting point of view. It's really quite amazing. That's why I said yes to this. I guess the question I'm going to sort of pick at here with our expert panel is, where does this go and how long does this last from an investing point of view? So let me introduce our guest today. Over on the far end there, Phil Ciano is the co-founder and managing partner of Bright Path Sports Partners, and he's a co-owner of Ipswich Town FC. This is the English Premier League. Very interesting investment that Sal and Phil and his team have made here. He's a founding partner of Ciano and Goldwasser. This is a national sports law deal boutique. He's responsible for Bright Path's overall leadership and origination of professional sports and ancillary investments. In the middle, Sal Galatiato is a president and founder of Galatiato Sports Partners. It's the leading firm in the sports finance and advisory business. Sal has overseen more than 125 transactions in major U.S. professional sports leagues for over 30 years. In 2010, he was crowned the king of sports M&A by Bloomberg Businessweek and one of the 50 most influential people in sports business by Sports Business Journal. We had a very interesting discussion on the pre-conference call with Sal, and he has amazing insights into the business. And right here on my left immediately, Charles Baker is a partner and co-chair of Sidley Austin Entertainment, Sports and Media Industry Group. Chuck has represented franchise owners across the NFL, Major League Baseball and Soccer, the NBA, NHL, and National Women's Soccer League, including the Mexican Football League as well, and a lot of European football leagues as well. He recently advised on the record-breaking $6 billion plus purchase of the Washington Commanders. All this is a lot of fancy language that he's the expert in sports M&A. Okay? That's why he's here for that. So if you want more on the bios, I don't like reading long bios. It's all in the program. We may have time for questions at the end. Well, I think Mindy might collect a couple of the questions and we'll see if we can get that. So what I want to talk with, and Sal, maybe I'll start with you because you've been around an awful long time. I really had a good time chatting with you at the conference.
I'm older than dirt.
Older than dirt.
Thank
yeah.
you for reminding me.
Okay. I just want to start with the prices. I want to read some of these prices to you. I've been astonished here. The Broncos, $4.7 billion. The Commanders, $6.2 billion. A minority interest in the Dolphins, $8.1 billion. The Celtics are supposedly on the market now. I don't know what the numbers are. I heard $6 billion. What accounts for this astonishing increases in prices in the last few years?
Well, how much time do you have?
Yeah, sure.
Look, one of the main drivers is media content value. As technology continues to improve and people are able to record their favorite shows and edit out the commercials, guess what the value to an advertiser is? Zero. Okay, 99.5% of people that watch sports watch it live. There's no other content like it. So that's a huge driver. The second thing is scarcity. Look, I don't remember a lot from my economics courses because I am older than dirt, but I do remember this. If supply is basically fixed, I mean, the number of these teams isn't going up, and the number of people that bid on them and institutions and blah, blah, blah continues to grow because capitalism is a wonderful thing. Guess what happens? If supply is fixed and demand grows, prices go up. Gee, that's not real hard to understand. And I've been hearing this male bovine defecation that it's a bubble for, since the mid 90s. I'll give you my biggest client before I left corporate banking to move into sports in 1996 was Kodak Corporation. Their market cap was around $31 billion. If you had $20 million, you could have purchased $20 million of Kodak stock or 10% of the New York Yankees. Which investment do you think you'd be happy about today? Go ahead, give me a show of hands.
Ask them later.
Yeah, how many Kodak people are here? Most of you don't even know what the hell Kodak does.
Yes.
So, I mean, I don't see, look, the demand is overwhelming. Right now, we're selling limited partnership stakes in 5 baseball teams, not small stakes. I'm closing on a $625 million raise for a baseball team on Friday. Okay, 625 million, not a little amount, not a little piece. Okay, 4 other baseball teams, a $375 million stake in an NBA team, and thank God we just engaged to sell a stake in an NFL team. Do you know how many bidders I'm going to have on that? Try like more people that are in this room.
Yeah.
So guess what happens when you have so many bidders? You create
Right.
tension
But
and prices go up.
I just want to move on. Phil, we've had bidders before, but we've not had these kind of stratospheric prices. If you map this on a chart, I mean, come on, it's gone like that. Okay,
Again.
something else is. But I want to get Phil in
Go
here.
ahead.
Phil,
Go ahead.
go ahead. Give us your thoughts.
No,
There's
it's
something
true.
else is going on here other than just there's a few bidders around, and all of a sudden.
Yeah, no, there is. There's a lot. There's a couple trends that are occurring and have occurred over the last decade, but I would say for sure in the last 3 to 5 years, Bob. And the valuation is being driven by a number of things, in my estimation. And the first and foremost is the infusion and inclusion of institutional capital, private equity, sovereign wealth. Those are going to continue. They're not only have driven valuations high to begin with, they're going to continue to drive valuations through the roof. Globalization of the brand, globalization of sports as ever increasing as technology increases, the spread of the information and the spread of the audience that can consume this product, like Sal aptly noted, the last bastion of appointment television is sports. So you have content, you have media, you have globalization, you have the infusion of third-party capital, private equity, institutional money, sovereign wealth. I think the confluence of these events, syndication, Bob. So 50 years ago, 30 years ago, 25 years ago, sports teams were owned by billionaires, an individual or a family. That changed. Leagues began to allow syndicates to come together, groups of investors to come together. All of these things, I think, are creating, as you aptly noted, a perfect storm. And that's where
I like this. You see, you think like I think. I look at the world as a PowerPoint presentation. So to me, like, why are we having these crazy prices? Syndication, new investors, globalization. Those are 3 PowerPoints. You have something to add to this? How's your perspective?
Well, first of all, thank you for having us here. This is obviously a topic we care deeply about because it pays for our kids' college. I don't disagree with anything either of these guys said. I think an important economics point as well, which Sal forgot, is not just supply and demand and limited supply. If you look at the leagues, particularly the US leagues, they are unregulated monopolies. So as you go across the leagues, they average about 32 teams. As an owner of a team, you own not just the team and an exclusive geographic footprint where no other team can play. You also own 1/32 of the league itself. And each of these leagues are global growth properties that have very strict rules and regulations, including, other than baseball, among other things, collective bargaining. And what collective bargaining does is, as healthy as it may be for the players, because it enables them to collectively bargain, what it really does is it suppresses wages. So if you think about that, there is a cap on your biggest expense. So you're investing in an ecosystem that is somewhat monopolistic. I would say it is monopolistic. Your revenues continue to increase, as these guys said, on the back of your media deal, because sports are the last thing supporting NBC and the whole cable ecosystem. Your expenses are, if not fixed, at least increasing, but only as a percentage of your revenues. And so it's a perfect investment scenario. And to Sal's point about Kodak, if you go back to when you started at CNBC, Bob, the compound annual growth rate of sports as an asset class exceeds every other asset class on the planet, from S&P to you name it. I think the 3 C's, as I call them, may have exceeded the growth rate of sports. It's classic cars, crypto at some point, and cannabis. And I think other than those three asset classes, nothing has increased.
Well,
I think
Go-
there's one other thing, if I might.
Go ahead.
interrupt here. Look, business life cycles are getting shorter because technology is accelerating, right? There's no technology risk in this business. It's very limited. They've been playing baseball since before the Civil War. I wager to bet that the odds are better that in 100 years, the New York Yankees will be here than Apple Computer will be here.
Oh,
Because the product life cycle of those companies shrinks. People invent new technologies, things change. It doesn't in this business. The other thing about this business is it is incredibly resilient to downturns in the economy. And I'll give you an example. During the Great Recession, remember the Great Recession, the world was ending, the banking system was ready to collapse. Lehman Brothers went bankrupt. Bear Stearns should have gone bankrupt. Okay. I got hired 6 weeks before Bear Stearns got into distress by the Ricketts family to buy the Cubs. It took 2 years. The Tribune companies, which owned the Cubs, went bankrupt. We had to buy the Cubs through a 363 sale. We still wound up paying the highest price to that point ever for a Major League Baseball team, $845 million. During that Great Recessionary period, there were 7 control sales, 7. 6 were all-time record prices. The 7th was the Pittsburgh Steelers, and it wasn't only because one of the brothers bought in his other brothers. In that transaction, I had an all-cash bidder who would have made it the highest price ever paid for an NFL team. What other asset class can you say that about during the Great Recession? None, 0. I mean, if somebody raises their hand and tells me, believe it.
If I might, real quick,
Go ahead.
follow up on Sal's point. Recession, depression, world wars, inflation, totally uncorrelated to the market generally. And here's a big one, pandemic, global pandemic. If you could think of a dislocating factor that could cause sports and the bubble, as some idiots call it, to crash, it would be a pandemic, right? You can't go watch your teams play.
Right.
They didn't lose value.
How many teams filed?
0.
0.
So,
How many business
you
teams they
foresee a ever spiraling increase in prices ad infinitum?
It'll go up. It may not go up at the rates it is now. Maybe it'll come down to, the low teens. But
Are the laws of investing don't apply to sports investing at all? The laws of gravity are repealed?
Supply and demand.
Supply and demand. Look,
Don't say that as if it's a magic word. All of a sudden,
But
we're
it-
going to change
but-
like,
but
oh
it-
my God, the laws of physics have been repealed.
Okay. See this baseball? If I drop it, it'll fall. It doesn't matter what the economy is, the inflation rate. The fact is that billionaires are being created all over the world. All over the world. The number of these teams is basically fixed. And if you want to get into this business, you have to pay up. We sold the Ottawa Senators last year. Can anybody tell me you can't fly from New York to Ottawa nonstop? Okay, it's in the middle of nowhere. It's the 44th largest market in North America. We sold it for almost $1 billion.
Yeah.
Okay, why? You know why? Because we had 14 bidders.
They like hockey in Canada.
They do, but I mean, give me a break. We had 14 bidders.
So there is no cap on this at all.
so what happens, Bob, too, is each time you see a transaction where people scratch their heads, Ballmer buying the Clippers at $2 billion, people are like, that's the dumbest thing I've ever seen. Okay.
Not right, really.
Now Matt Ishbia comes in last February and buys the Phoenix Suns for $4 billion. People say that's the dumbest thing I've ever seen. The Celtics are going to transact at $6 billion. Josh Harris and David Blitzer, thanks to the great Chuck Baker, bought the Commanders,
Their money.
a losing franchise, for $6 billion. People said that's ridiculous. And now the Dolphins transacted, to go to your point, Bob, earlier, at a minority position with Stephen Ross bringing an LP in at an $8.1 billion valuation. If they're worth 8.1, what are the Dallas Cowboys worth? What are the New York
Right.
Yankees worth?
Right.
Where does it
that's
end?
that's the old game on Wall Street. If Apple's worth this and what's NVIDIA worth, we've been doing that a long time. Let me just move
Yeah.
on here.
Yeah.
How should investors broad investors view sports investing. Is this a new asset class? I mean, is it different than a stock or a bond or real estate or even Bitcoin? Should you look at it? Is the people in this industry who would most profit from this, that's these guys, would they try to pivot or position this as a new asset class?
Yeah, I think the way that you look at it now in sports, Bob, the way it's changed is the investor of sports, the owner of sports used to be a singular asset, the team. And the asset class revolved around the team. Now, I believe the way that you've seen these confluence of events that we've talked about of technology, globalization, reach, scarcity, the increase of wealth globally, et cetera, these things come together. And Bob, they're now more of a mutual fund concept where the ownership of the team includes real estate, rights, media deals, other assets within the spectrum, such as many of the NFL owners now own English Premier League teams, own MLS teams, own a piece of the action in these other sports. So what they're creating, Bob, to the investor is getting much more than a team. It's getting a portfolio of investment within the ecosystem, I would say.
So is it a new asset class? One of the characteristics of a new asset class is it doesn't move in correlation with other asset classes necessarily. Is anybody making this argument?
I guess I'm troubled by new asset class because to Sal's point, the Yankees have been around, 100+ years, and most of these teams.
But you don't have private equity suddenly getting
You
in,
don't.
and you don't
And
have
so-
some teams that may be in fact go public. Some already essentially. I mean, Madison Square Garden, essentially you can own the Knicks in a public.
Right. And so as an asset class, it's evolving. I wouldn't say it's new. What we've seen over the last decade or so, particularly in Europe, where there are no real limitations on ownership, is we've seen sovereign wealth, private equity firms, oligarchs until we had a war in Ukraine, and other institutional capital coming into those teams, right? So new liquidity, increased prices, entities buying in that don't really have price sensitivity. They are using the teams to promote other causes, to promote their economies, to promote the global influence of their countries. And so the class has evolved. Just before COVID, the leagues, recognizing how high prices were going, recognized that it was becoming increasingly difficult to continue to employ what we call the two-legged rule, meaning you needed two legs to own a team. Not the case anymore. And so they gradually broadened to start permitting private equity investment in a very limited sense, NFL going last because they didn't really need it, and they've just approved it about a month ago. And so I don't think it's a new asset class. I think it's an evolving asset class.
I mean, I've been doing this since the 90s. It's not a new asset class. It's finally been recognized as an asset class, I think, because it's been growing. I think that because private equity has been allowed to come in, now more people are looking at it as potentially an asset class. Look, as these valuations continue to grow, at some point, these things are going to have to go public. They just are. I mean, it's one thing for Jerry Jones to tell me that the Cowboys are worth $14 billion, but under NFL rules, how do you buy them? I mean, a single individual has to own 30% of the equity. I mean, how many people can write that check? So as these teams become more valuable, I think the leagues are going to continue to change their rules slowly, let first more private equity in, and then potentially let these things go public.
So you think that I actually was going to follow up with that question. How does the public get in on this? I mean, I mentioned Madison Square Garden. They own the Knicks and the Rangers. The Atlanta Brave Holdings exists, right?
That's a tracking stock. Yeah.
That's a public tracking. And isn't the Toronto Blue Jays owned? They're owned by it's Rogers Communications, right?
So indirectly.
I don't know of any NFL. Isn't Green Bay? Green Bay you can
Green Bay
own,
is still
right?
public, but doesn't really trade. You can invest in a slug of Man U. There's limited opportunities to invest publicly now that.
But you agree with him that there's going to be more companies going public?
I think so. So Ted Leonsis, who owns Capitals, Wizards, and the WNBA team, we're helping him build a new arena in DC now. He owns the regional sports network there. He believes, and I think he's right, that looking at his his bundle of assets there, that and the value of it, that it's ripe for going public. I think you may see it. I think, part of the problem for the leagues is they've never really welcomed public ownership. And one of the reasons for that is they don't really want to, they don't want their team owners, they don't want the teams driven by quarterly results. And rather than trying to win, they're trying to produce results. Secondly, they don't want the public to have access to all their financial information.
Exactly.
Which
yeah.
they'd be required to
Yeah,
do
yeah.
if they were public. And so there's going to be a lot of pushback against it. Ted is Leonce is one of the guys who's pushing for it to
Right.
happen. I think you're right, Sal. Eventually, it may,
Eventually,
but it's
Right.
gonna
But
take a while.
this makes a lot of sense, Phil, because if you accept this ever spiraling, somebody's got to have an exit strategy somewhere, and
They do.
There's public markets as a logical exit strategy.
Public markets, absolutely logic exit strategy. And in the monumental example that Chuck just brought up, Bob, you saw for the first time ever sovereign wealth
Mhm.
come into indirectly the NBA and the NHL because the Qatari
Right.
sovereign wealth fund came in and bought a piece of the action. So you're
And now we
if
got
you-
oil money involved.
oil money. Now, if you introduce that component
Yeah,
into the
forget
mix,
about it.
you're talking about trillions of dollars,
Yeah.
not billions of dollars. And so I couldn't agree more with these guys. I think the next frontier will be the public markets.
Phil, you brought up a great point, and I guess I'm wondering myself, what do you get when you acquire a stake in a team or league? So is it primarily just about the team itself? Or where does the entertainment, the digital content, the rights, the apparel, the hats, the hospitality, the real estate, where does that come in as a factor? Is that 40% of the value, or does it depend on who you're talking about? I'm just trying to think of all the ancillary things besides just owning the Mets or something
it
like that.
depends on the league. Each
You took
league
the
has
words out.
different rules.
Took the
right?
words out of my mouth.
So if-
Absolutely.
If you own a piece of, if you own an NFL team, right, you get the same share of the national media contract, whether you're in Buffalo or you're in New York City. So it's really socialism for billionaires. It's the only place in the world socialism actually works.
It's 100%.
Okay. There's a salary cap, which is a hard cap. So whether you're in a small market or a big market, you're not going to get competitors that can be predatory and raise the payroll of their teams. Everybody's almost guaranteed to make money. And then the apparel is shared, anything outside of your team store is going to be shared by everybody. And then the visiting teams get a share of your gate. And so each league has different rules,
Yeah.
but they also have heavy duty revenue sharing. That's one of the reasons, but you're buying the team, which is a brand and a market, but you're also buying the league and the growth of the league. And that's really important. That's an important driver.
It's almost like a bond-like thing. It's like an annuity. You have cash, you have certain cash. It's like a bond. You get a cash flow here, and you can estimate, what the value of that cash flow is.
And I would say
But
too,
I want to get to the more specific question, like, is the value of the Mets, 40% the team and 60% everything else, the real estate and everything that comes with it? Or is there a way, is there a way to think about it like that, or?
yeah, so I agree with Sal. It'll go league by league, Bob. But there's an old saying too, you don't make your money on the hot dogs and the tickets.
Right.
You make your money on exactly what Sal said, the rights, the media, the real estate play. You're sweating equity out of the venue. One of our first portfolio investments is, as you mentioned early on, they weren't a Premier League club when we invested and we bought our interest in the club. They were in the Championship League, which is a tier below in the English Premier League. So the media rights last year for this particular club that we invested in were £8 million. So at the exchange rate last year, that's about 11 or 12 million US dollars. We then closed our transaction in June. They were promoted a month earlier in May. And the media rights alone in the transaction will now exceed what our investment was. We'll be close to 200 million US dollars in 1 year. So you go from $8 million in one tier below in the English Championship League to the Premier League, and you've now opened up a whole new area of revenue. Then you bring in strategic partners that can sweat other areas of revenue out of your particular asset class. The stadium, and the US is always about a decade ahead of Europe in these things. They don't have concerts at their stadium. They don't have live performances where they sweat it. They don't shoot T-shirts and hot dogs into the stands. It's the sport And it's the event that's happening that they're concerned about. And now as more and more American owners come into Europe, into European sports, you're going to see that change as the next frontier in our estimation. And that's why we're bullish on European sports at Breitbart.
So you think American investors are going to help, first off, expand the revenue base of those teams? Are they going to expand the viewership there? Are you going to figure out a way to get more people excited about their hometown? And I have a friend who owns the Venice Soccer Club, Duncan Niederauer, who ran the New York Stock Exchange, a friend of mine. He left the NYSE and said, "I'm an Italophile." He moved to Venice and bought the Venice Soccer Club. I was with him a little while ago. He's very excited about it, but it's never done very well for a long time. But he thinks he can help turn it around. God bless him. I love Venice. But there's a guy like you think like, how are you going to do this exactly? And
So it started with, as Chuck said, the Glazers who own the Tampa Bay Bucks and Manchester United, and now they brought in Sir James Radcliffe at a $6 billion valuation last year for a 25% ownership. It started with an American group. Then you saw Randy Lerner, Al Lerner, who used to own the Cleveland Browns with Art Modell. His son gets into the mix, and everyone's like, well, that's interesting. What's going on in Europe? Now in the English Premier League, Bob, you have, imagine if in the United States, half of the NFL teams, and believe me, it is just as tribal, visceral, and prideful in England of owning and supporting a Premier League football club as it is an NFL team here or an MLB team. Imagine if half of the owners in the NFL were English or European nationals. Right now in the English Premier League, half of the ownership is United States-based citizenship. So yes, the answer to the question is we'll continue to bring that commercialization in a very slow and respectful way because they're hesitant about it.
Yeah. Well, do they think like the damn Yankees are coming?
They do.
Some of them. Yeah.
They
Well,
do.
you can't blame them.
You can't blame them one bit.
If they're going to start shooting hot dogs into the stand, they're going to have a problem.
They're
right?
terrified.
Yeah.
Fireworks. They're ready for
And in
everything.
10 years, though, shooting hot dogs into the stands will be normal to them, right?
Yeah, it could be.
They'll get used to it. I want to ask about private equity because that seems to be an obvious major factor in this parabolic curve that we're talking about. And any one of you just chime in. Just talk to me briefly about the influence that the NFL is now allowing this in a bigger way. I can't help but think that that's important. You keep wrinkling your nose. You seem to.
But because it's tiny, because the NFL allows up to 10% to be owned by private equity firms in total.
Yeah.
Not 10% per private equity firm. It barely moves the needle. It's nice, but in the last 11 transactions.
But why won't they change that and go to 20%? And that's sort of built into the assumption of the bid.
Okay, let me finish. Okay. So the last 11 transactions, limited partnership stakes I've sold. How many have private equity firms won the bidding in?
Zero.
None. Because private individuals who have money have ego gratification that they get out of this. They get a lot of non-quantifiable benefits that a private equity firm wouldn't. And a private equity firm winds up being the low bidder. Plus, a private equity firm has an investment horizon, which is relatively short. If I'm a private individual, I'm a wealthy guy, I can own my stake in the Yankees for 30 years and pass it down to my children. And if I'm a private equity firm, my investors at some point are going to say, hey, where's my money?
But I think the limited horizon is a major factor. You could, if I was a private equity guy sitting here, we'd say, well, we're more disciplined bidders, which they always say in IPOs. That's one.
And
of
you know
the
what you
reasons.
call a more disciplined bidder? And
A loser.
A loser.
Yeah.
That's what they are. They're losers.
A loser on the bid. Long term, it's not clear.
Well, if you don't win,
I'm
then you don't have
suddenly
a private
representing
equity.
private equity here. I don't know how that happened.
Sal
Go ahead.
wrinkles his nose. I will say this. We do the same against each other, with each other. It's going to change some, okay? The leagues led by baseball first, pre-COVID even, recognized prices were going up. They needed more liquidity. As healthy as this market is, it is helpful to have more liquidity in the system. COVID happens, pandemic happens, the other leagues follow suit one at a time, and now finally the NFL. Each league has its own rules and regulations in terms of how much one private equity firm can own in a team, how many teams a private equity firm can own, and how much of a team's cap table can be owned by private equity generally, meaning by several firms. The leagues vary from league to league, with the NFL being the most restrictive. The deals so far have primarily been, and there are firms that have investments. Arctos is a firm that's probably got 18 investments already. Ares is probably in a dozen. These are firms, some of which are global firms, some of which are focused on sports media and entertainment. They've been primarily secondary transactions. I think as this evolves, as the leagues start raising a little bit how much they can invest, owners will start using it for primary capital, meaning they're looking to finance an arena.
Yeah.
It's equity, right? So it's cheap. Would it make sense to take $250 million slug from private equity? Some owners have done it. I think we're going to see more and more of it. So I think, Bob, it's changing slowly, but until the US has promotion and relegation, you can move between leagues for a second and third, or permits institutional capital, private equity, sovereign wealth to own control of a team, which ain't happening in our lifetimes. It's not going to move the needle.
Okay, so NFL is 10%, or right?
Yep.
Per team.
What would it take to go to, if they wanted to make it 20%, what would the owners have to vote on it?
Yes,
They would.
Okay,
they have to change the rules.
right. So what would prevent them from doing that?
Nothing.
They
Just
need
change
money.
the rules.
Nothing. They
Okay,
changed the
so
rules, they
the
didn't-
barrier to
No.
hire
It-
private equity is
Right,
not
and
Look,
and
that high.
if it benefits them, they will change the rules.
That's right.
Right now, it doesn't really benefit them to change the rules.
Okay. Let me move on. You mentioned, Phil, you were talking about the Americans going to Europe. How about the Europeans coming here with the World Cup in 2026? I live in Philadelphia. It's going to be one of the places for it, and everybody's all hyped up. The link, those big things going on there. This seems like a great opportunity to grow the sport, football, I mean soccer, in the US before and after. Is this the time? Is there a business opportunity? I mean, you keep talking about us going over there. How about soccer coming here?
No, I think the World Cup in 26 is will be incredibly impactful here in the US. I think what you've seen, Bob, is if you look at the growth of, in particular, women's soccer, NWSL, the valuations, I think just traded, Chuck, was it 250 million, Angel City FC?
We helped them buy Angel City for $2 million in 2020. We just sold it for 250.
So
Bob
2
Iger,
million to 250 million in a 4-year span. In women's soccer, where the media deal, Chuck, how would you compare the media deal in NWSL to?
It's much better than it was. It's still, you got to recognize, guys, the NFL is here.
Yeah.
Everybody else, including even the NBA, are here. And the rest of them, the women, are down here.
Yeah.
So I'm not saying that's a good thing, but it's peanuts compared to the NFL.
So Bob, with the growth of women's soccer, the growth of, you have 2 leagues in the men's division in professional. You have MLS, you have USL. You're seeing those valuations increase as well. More and more investment coming in. And the growth of this at the youth level in the United States it's taken longer than they thought. So, they thought it'd be a decade plus kind of growth mechanism to bring what's the biggest sport in the world, soccer, as we call it here, to the US. It's taken more like 3 decades. Yeah. And once we implement, what they do in Europe is they have the academy system. The academy system takes kids at a very, very young age. The club owns the academy. There is no minor league. There is no collegiate sport where you're excelling in an NCAA Division 1A environment. You are a talent that's picked out at a very young age, and you're placed into an academy, and you're educated, trained, and groomed in that academy to come up through the system and then traded in between the sports. I think you're seeing more of that now. You're seeing sort of a sub-academy, and then the growth of domestic sports, especially on the women's side, but also men.
Well, thank you for the segue, because I was going to go back to women's sports. What is driving the increase in women's sports? Should it be higher? And one of you mentioned more diverse equity participation in professional sports.
Well, look,
what can we do to do that, to help that out?
The reason we started Bright Path Sports Partners, my partner Jake and our third partner Jim Laporte, was, for the last 10 years, and Sal, can attest to this, being close with the commissioners in each of the leagues. They've talked about increasing diversity in the owners, from the ownership stack all the way down to the front office and beyond. When the Denver Broncos were about to trade, just a couple years ago, what people thought was a ridiculous number at $4.7 billion, Roger Goodell stood up at the podium, said to the media, the next owner of the Denver Broncos will be a person of color or will be a woman. The whitest billionaire family in the history of America, the Walton family, bought the team.
Because it's not about the money, it's about the money.
It's correct. Now, to add insult to injury, they then brought Condoleezza Rice in at 0.000000001, probably funded that investment and said, well, we have a African-American female in the ownership group. So what did we try to do there, Bob? So our thesis at BrightPath is, if we're going to do this, if we're really going to say, and we're going to say this is serious, and we're going to bring diversity into the capital stack, then let's do it. And we've our connection was to Native America. And Native America has been traditionally underrepresented in all asset classes, obviously, but especially in the scarce and lucrative space of sports. We started going to these tribes and saying, well, let's institutionalize your investment capital. You're in a melting iceberg. The casino has now become the phone. People are going to stop going to gaming. People are going to stop going to these resorts. Let's create generational wealth for your tribes and for your nations and create a permanent asset class. That's a start. Okay. That's a start, but it needs to be much bigger than that. It's not just women's sports participation. It's got to be ownership. It's got to be engagement. And it's hard to find.
Does Hard Rock know that you're concerned they're not going to go to casinos anymore? Hard Rock's owned by the Seminole Indians.
They are owned by
They must be very concerned to hear that you think that. I hope you don't tell them that.
They're doing just fine. They're blowing up the Mirage as we speak.
I go a lot to the Hard Rock in Atlantic City. I think very highly of that place, and I wouldn't say it if I didn't mean it. It's very well managed.
Yeah, they've done a great job. But Bob, the whole philosophy behind Native America is what's called 7 generations. When they make an investment and they make a commitment to their tribe, they're saying, we want this to be lasting 7 generations down the road. And to go to Sal's point from the beginning of this discussion, sports, media, and entertainment will be 7 generations from now. Casinos, who knows?
Yeah. Let me ask you this question on sports gambling, because it's an issue that bothers me, because on the one hand, I'm basically, as much as you can reasonably be, I'm a libertarian. People want to gamble on sports. People have done it since time immemorial, since sports was around. Why shouldn't they be able to do it? On the other hand, do any of you worry about the corrupting influence of the game and the fact that you turn on ESPN, you have active, discussions of gambling odds mixed in with sports commentary. Does that worry you at all about the corrupting influence of sports gambling? Boy, suddenly no one has nothing to say. Look at this. I got 3 blank stares over here.
I'll answer that question.
Look, I think the English have had it right. I think the English have had it right for 100 years. No, but I think,
in the stadium.
Yeah, I mean, the bookies are all around. Why has cannabis become legalized, except for on the federal level? I mean, people are going to gamble on sports. There are restrictions, there are guardrails. And we know that when athletes or their assistants, in the case of Mr. Otani, find themselves in that mix, there's ramification. Pete Rose, who just passed away, isn't in the Hall of Fame, the greatest hitting fielder in the history of
a terrible
baseball.
record on betting on sports. Astonishingly, Pete Rose had a terrible record. There's been studies done about it.
But he had a hell of a bat.
But gambling is not a new thing on sports.
No.
People have been gambling on sports since
sports.
They invented,
Yes.
a rock that they could throw at each other. And I mean, it's just become codified now and it's become legalized. But I don't worry about that. I mean, I just see it as a way to kind of increase interest in sports. And gaming has a huge effect. In England, when they legalized gambling, the television ratings of the EPL went way up.
Yeah. that
And
doesn't
it's because
surprise me.
people watch games they have no rooting interest in. If you put down $200 bet on, I don't know, the Athletics playing the Mariners and you're a Yankee fan, usually you don't care, but you have $200 on the game and you're going to watch it. It's going to increase the ratings. And that's what's starting to happen.
Yeah, it's a different, I was sort of asking more about the corrupting influence. How do you guys feel about high school and college athletes getting paid to play? Does that concern you at all?
Chuck, have you guys done
Three
any?
more stairs, Aubrey. I'm really batting 1,000 here.
Bob, that's the Wild West. I mean, I don't even know how to comment on that because nobody knows where that's going. The conferences are falling apart and then they're being reconstituted. I don't know what the limitations are. Players move from one school to another. I mean, right now, it's a mess. I don't even know how to comment on it.
They're talking about doing a super league now, Bob, where we're going to see in the next 5 to 10 years, there won't even be conferences anymore. You're going to see the NCAA collapse and you'll see these 50 teams from these major schools that will come together and will begin to operate like a professional sports league.
I sound like an old-fashioned fuddy-duddy here, but does that bother you that suddenly you're going to have, high school and college kids that are going to have big sports agents and suddenly are primarily going to be influenced by the money? I know I sound like a fuddy-duddy, but there's a purity to college sports and high school sports that I've always loved, and somehow this bothers me.
So Nick Saban
Am I just a fuddy-duddy, or is this not something I should?
So Nick Saban can make $10 million a year coaching Alabama. They can make $1.5 billion in 3 years on media rights, but the people that are generating the wealth for them should not be compensated.
I mean, it's there's a lot of moral and societal issues to it. There's the economics of it, but these young men, young women are driving the revenues at these institutions, and shouldn't they have some share of it? It is the Wild West, Sal. I agree with you. It's going to be really interesting to see where it goes, the legislation, the NCAA itself, individual colleges. It's the Wild West.
And to me, yes, it does bother me. It does, Bob. It does. But think about it. For decades, these young people were generating billions of dollars in revenues, and they weren't being compensated. Yeah, they were told that they were student athletes and they were going to get an education. But what percentage of them actually graduated? Very few. So why aren't they compensated for the money that they generate? It's a fruit of their labor. Nobody's watching Alabama play football to watch Lou Saban. They're watching Alabama because of the players, and the players weren't being compensated. It's really not fair. But I take your point that it's kind of daunting when you think of young people being exposed
Think of an
to agents.
18-year-old kid. I mean, think of
It's terrible.
people that are going to descend on those kids.
Oh,
The agents.
it's going to be awful.
Right.
And there's no
and then
regulation
it's,
either.
I don't know, I keep repeating myself, but it seems like it ruins the purity. When I watch, my favorite sport is college basketball. I think those guys are the greatest athletes on the planet.
Yep.
You drag each other up and down the court
You're
for that amount of time. They're just amazing athletes.
Yeah.
And I think, like, what happens when somebody offers them $5 million and the influence on them just to miss a jump shot, for example, they're humans.
Yeah.
And I would hate to have the whole beauty of the game. Look, you guys are famous business people, but you're sports fans too.
True.
I don't want to see the game I love get ruined, or people start saying, "Oh, that guy, he missed that free throw on purpose." You don't want to ever hear that. You want to know everybody's going balls to the wall every time in every game. Everyone wants to believe that because that's part of the game. Everyone's all in on the game. There ain't nobody hoping that we lose in this game.
I couldn't agree more, but
Same.
there's a real dichotomy here because the people that are generating the revenues for the schools are not being compensated by the schools. And then, so what happens to them? Their eligibility is up. They haven't been compensated. They haven't gotten an education. And so what do? I mean, it's not fair. So But I take your point because
Yeah.
it does hurt the fan experience.
We are just about at the end here. We got a couple of questions. This one here, thank you for asking. I don't know who it is, but it goes back to the question about valuations. At some point, prices reflect a multiple on revenues.
Mhm.
How much can you continue to raise prices for the fans and for the TV rights? So this goes back to my question about spiraling costs. At some place, it's got to be some relationship. Some point, Comcast might say no.
Maybe. I mean, when that point comes, then it will have an impact.
Have you called
But-
Brian Roberts? Because we haven't gotten a no yet. Brian.
Comcast also owns the Flyers. You know, they own
The building,
sports
yeah.
assets. They own the building
Peacock.
there. They owned at one point the 76ers. They're in the sports business, right? They need the media content. They're going to determine what that media content is worth. They're experts. At some point, they're going to say enough. And then you're going to get a deceleration in the upward movement of price, for sure. But when that day comes, I don't know.
Yeah,
I mean, it hasn't, right?
right.
So,
No.
But you agree
25
with
years of doing
the
this.
premise here. There is at some point a relationship between, how much you're paying and the revenue that you can get.
Yes.
essentially.
Yeah,
And it doesn't,
but
it doesn't
let me-
exist.
let me-
The laws of gravity are not repealed. I know I said that.
Let me ask, as technology improves and as artificial intelligence does more and more work, and as more and more people are going to have more and more leisure time, they're going to need to consume something, right? And this is a product that they want to consume, is sports. So when you're continuing to get incremental viewers and people have more leisure time, there is an argument to be made that the value of those sports rights, media rights, are going to continue to go up. Look, every time I look at what the leagues get, and I scratch my head and I say, "That's nuts."
Bob,
And yet the next contract is even more nuts.
Bob, in today's Sports Business Journal, I was reading this on the train up from DC. The top 75 telecasts of the 2024 live television through the third quarter. And of those top 75, all but 6 of them were NFL sporting events.
Yeah, probably 5 of the other 6 were other sports
Right.
They
events.
were the Olympics,
Right.
and they threw in a couple of the presidential debates.
Yeah.
Okay.
Yeah.
It's
So,
it's
like,
Yeah,
I'm reading this going,
once
I mean,
every
this
4
is-
years.
Yeah, every 4 years. One thing, that's
Yeah.
what I mean when I said sports unites the world. Every 4 years, the presidential debate will do that. But that's every 4 years.
That's it. Where I do think the consumer is going to get squeezed, and this is what you're seeing now on the venue side of things, is as the valuations increase and the value of this asset class increases and the monopolization, I think you're going to see smaller venues and more premium seating and more premium experience to where the regular fan is now going to get squeezed out.
Oh,
That
you've already seen
You're
that.
seeing
I
it
mean,
now, and
when
it's gonna-
people
yeah.
look at attendance in Major League Baseball games, they say that the attendance is going down. Well, that's true because the owners realize the law of triangles is if you build a 70,000 seat stadium, it's a lot more expensive than a 40,000 seat stadium. But if you can generate more revenues from a 40,000 seat stadium by having all the luxury suites and club seats, and you build a smaller stadium, it costs you less money and you make more money from the venue, you have less in financing costs. Well, yeah, if you look at the raw statistics, attendance goes down. But new Yankee Stadium has about a 49,000 seat capacity. Old Yankee Stadium had a 73,000 seat capacity.
And the new one's more profitable.
Yeah, by
100%.
far.
look at the Las Vegas.
Because,
Because they have 1 million suites, they have
Yeah.
1 million club seats. And I mean, I was
Good
at the
point.
game last night. I went from suite 7, which was the Yankee owner suite, to suite 57, where they put the Dodger owners. And I don't know how many more suites there were around the building. It's got to be 140 suites. And every single one of them was sold. And they ain't cheap.
okay, this has just been a fantastic conversation. These are 3 of the best people in the business, in the sports business. And you got this only here at the Museum of American Finance. I've been a trustee for many, many years here. I'm proud to be a trustee. This is a very important organization. If you're not a member, please join. You not only get a great magazine of financial history, but there are programs like this throughout the year. You can also view them online. And the museum itself is not just about what we're doing here today. It's about promoting financial literacy. David, the president, does innumerable lectures on financial history and promoting financial literacy. And believe me, as a financial journalist, I don't worry about what's going to happen to the S&P 500. I really don't, even though people ask me every day, I don't. I worry about people understanding finance, understanding business, understanding investment, and I worry that a lot of people don't and make very ignorant, silly decisions. The museum was founded to help people with financial literacy and to help them understand. So please join. I want to thank our guests, Sal, Phil, and Charles. It's wonderful. The bar